Good evening, everyone, and thank you for joining us. My name is Stacy Varghese, and I'm the Associate Director in the Office of Advancement at St. John's University. Today, our special edition series on small business continues. John Cipriano and Joe Casper are panelists this evening, and they will discuss how far ahead you should plan in your business. Some housekeeping rules before we begin. If you have a question, please submit it on the bottom right in the Q&A section to panelists, and they will be answered throughout the fireside. For the full experience of today's webinar, we ask that you choose the side-by-side view. You can find this option on the top right of your screen. As a reminder, please make sure to keep yourself on mute. Lastly, a recording of today's session will be emailed to you after the presentation. Now, I'm excited to introduce our speakers. John Cipriano is a principal and wealth manager at Modera Wealth Management, LLC. As a wealth manager, he has had the privilege to provide advice to high net worth individuals, families, businesses, nonprofit organizations, and fiduciary clients in all areas of their investment and wealth management needs. John has over 25 years of experience in financial planning, taxation, business consulting, and financial counseling for business owners. John also served as an adjunct faculty member with St. John's University and the University of Florida, where he taught classes in business management and finance. Joe Casper is the Director of Strategic Development at Modera Wealth Management, LLC. In his role at Modera, he provides business development support to the firm's wealth management team. Joe is responsible for cultivating alliance partner and new client relationships and uncovering new business partnerships. Before joining Modera, Joe was the Vice President of Business Development at a healthcare IT startup, Visual Clinic LLC. Prior to that, Joe was with Allergan INC as a Senior Business Advisor, where he consulted and offered services to improve the client and professional alliance partner experience, added new service lines, facilitated financial and operational benchmarking, and mentored organizations on change management. Welcome, John and Joe. I will hand the webinar controls over to you now.
Thank you, Stacy. We appreciate the introduction and the kind words. I look forward to this session. This is part 3 in our series, as Stacy said. We had 2 previous sessions, one that focused on leadership and one that focused on taxes. And this is a nice continuation today in talking about the subject matter which relates to setting up your business for success, the ways to do it, so that at the time when you're ready to sell your business or have a succession plan in place, it is going to position your company in the best light so you receive the most value for it. I have the pleasure of working with Joe over the past number of years, 3 years now, I believe it is, and we have collaborated on a number of client cases and in making presentations to small businesses to unleash the potential to help them prosper and grow. Ignorance can be bliss at times, but what you don't know can hurt you or leave a lot of money on the table. We look forward to sharing things with you tonight in this area here. And with Joe's extensive knowledge and my background as a CPA and also working with individuals in planning, I think we make a pretty great team. Joe, you want to just tell people a little bit more about yourself?
Yeah, just a few other things, John, just around me is I'm based in Boston. I come from a family that is a small business owner. We just hit our 92nd year in terms of a family business. And it's really, something quite interesting where we're seeing so many opportunities where small businesses are getting the opportunity to sell their entity. And so I think that this is a real timely talk, and I think we're going to share a whole bunch of really great stuff along the way. The other thing is, I play a lot of tennis. I am a certified tennis pro, and now I'm starting to work my way into pickleball, with that type of thing. And to get ready for this presentation, I kind of like, John and I were both on our blues. I said, okay, this is the red storm. I have to go and find something red. went into my closet, and the only thing that I could find was the Red Sox shirt with Mookie Betts on the back. I said, well, this is not the right crowd to be going and bringing that. So we're gonna set that aside. But I think what John and I are going to talk about, I think is going to be really, really valuable in terms of setting your business up for just a really enhanced sale.
Thank you, Joe. As a matter of fact, Joe and I work with clients around the country with a focus pretty much on the East Coast. And both of us have worked with clients from Massachusetts to Florida. I meet clients regularly in the New York area as well. So we look forward to going over this presentation. Joe, why don't you go over briefly what the areas that we're going to cover today, and then we'll get right into some of the nuts and bolts.
Yeah, so the first thing we're going to talk about is, are you wearing the right shoes to the dance based off of your business structure? Is your business structure the right one for right now, and going forward, if let's say you're going to be going and setting up your business for sale? The second thing is, most of the valuations go back to excess cash flow. So you really should be looking at this whole element of your numbers and developing a really active budget, so the numbers are quite strong. And then the third one is how do we basically go and enhance the value of our business? And I'm going to share a technique that I've worked with dozens of entities, small business owners to kind of unlock that value. And I think it's going to be something that you're going to be able to go and put into play tomorrow, next week, and do it really, really effectively. And I think the one other thing that's kind of like not on here, we're looking at all these aspects of selling your getting your business ready for sale, but it also the thing that is kind of almost the elephant in the room is it the right thing for you? Is it the right thing for you to go and sell your business? And I just had a client that came over as a client with Modera, and for 2 years. He was running after that Greyhound bus, working on going and selling his business, and he cleaned up his balance sheet and cleaned up his income statement and ran to things. They started off with 27 suitors, took it down to 3, decided on the number 1, got a 10x multiple off of cash flow, and then just a few months after that, he just basically said, "What did I do? I gave up control of my business. This isn't what I was thinking it was going to be," and now he's trying to go and unravel the sale that way. So we're going to really talk about this whole aspect of enhancing and unlocking that value. But there's also that other piece around is it the right thing for you, your stakeholders, the people that work for you, and your family in order to go and sell your business. John, do you have anything else you wanted to just kind of share around that?
Get the most value out of it. That is not only the enjoyment of what you're doing by running a really good business and having great people surrounding you, but it's also about getting the most out of it. The more profit that you can make in a business by leveraging your time and helping people, the more satisfaction you're going to get. You're going to have better opportunity to retain the best and pay people better salaries so that they stay longer, enhance it with some benefits that people find valuable. But the reality is that if you are going to try to sell your business one day and you work really hard and you want to get that value out of it, you want to make it a smooth transition. And in order to do that, you have to set up the procedures and processes and people to be able to carry that on when you leave. So the chance of doing that at the right time is not only your own preparation in terms of mentally about it, like Joe was just talking about, but also, people talk about, did you just get lucky? Well, I sincerely believe that luck is all about planned preparation when it meets the right opportunity. And you don't know when these opportunities are going to come along. Joe, remind me later, and I'll tell a story about a client that I had in the lumber business and how they missed that opportunity.
Sure.
Okay, great.
Yeah, I'd like you to go and just talk around this that first agenda item, and that really goes back to this whole aspect of your business structure. So, John, with the different clients that we've worked together around, and also other clients, what is the best business structure?
Well, it all depends. A lot of times it depends on the stage of where you are in the business, where you're just starting out, whether you have partners or would like to have partners, whether or not you have liability concerns on the type of business where you're prone to get sued for something or another, like doctors are prone for malpractice. People in our business can be sued for errors in what we do. People could be sued if you're in a trucking business for one of your truckers hitting somebody where they're out making deliveries. There's so many exposures that every different type of business has, and knowing what those exposures and risks will help you make the decision on what type of entity may protect you better. And the ones that don't have that, there's different situations. So let's use this simple chart here to use as a reference point. So most people start out at sole proprietorships. It's simple, it's easy, it's by far the lowest cost to set up, and it's typically started by one person. And that person may start out in a very simple service business, and maybe start out all by themselves, and then grow to have more than one person. But the simplicity of it and not knowing whether it's going to be successful or not, even though you have the best of intentions, you usually find out in the first year or not whether you're making traction. There's unlimited personal liability to that, so you're going to make sure that you have proper insurance if you choose this entity in terms of protection if you were to get sued. And your taxes are very simple. It's called a sole proprietorship because there's a form with the IRS called a Schedule C, and that's for a sole proprietorship to claim all of their income, their revenue, and then all the associated expenses of running that business. Well, if you wanted to have more than one person working with you, you could jump right into a partnership, another very simple entity to establish. And the best thing to do, though, is have a partnership agreement. The problem is a lot of people, they go, oh, let's see how this goes, and they throw some money into it. And if it starts to get excessive and you don't have a partnership agreement, you also don't know how the divorce is going to go if it happens. So having a partnership agreement in place right at the beginning, even though it may cost some money, even if you do it amongst yourselves, make sure that you get the consultation and legal advice whether this is the best one for you. And by the way, I want to preface this whole discussion. This is not us giving advice and giving a directive on any one particular one. It's just that through our experience in working with CPAs, which I am myself, and also attorneys, they can help guide us when they work collaboratively to find out all the pros and cons that you're facing when you're making this decision. So I just wanted to preface that as an override for this. So in a partnership, it's also very flexible. You could make arrangements on having the same salaries, different salaries based on what you do and the value of what you do for the company, as well as having different ownership percentages and ownership profit distributions. So it's a very flexible entity, and it's also very simple. C corporations are usually when you're trying to have multiple owners, especially even though you could start it with one person. I typically see them in today's business environment for when they're trying to raise a lot of capital and they're able to sell shares in the corporation. Similar to those of you who, believe it or not, would invest in like Exxon or IBM out in the marketplace. They're typically C corporations because they have to be in order to have that many shareholders. S corporations, differently, cannot have more than 100 shareholders in them. And that may include a husband and wife counting as one, but it typically it legally can only have up to 100 shareholders though. And it provides a great opportunity there, different than a C corporation, because C corporations are taxed on whatever it earns at the corporate level. And then if there are any dividends passed, that same earnings is taxed again on your personal level. So there has to be a compelling reason, which is typically to raise capital or have over 100 shareholders, why you would want to start or become a C corporation. An S corporation is very flexible, and it gets taxed on at the personal level. So it really acts as a conduit and passes through that income to the individuals. The benefit, though, different than a sole proprietorship and a partnership, is that you take a wage in a S corporation where a partnership income, net income, and sole proprietorship that gets passed on to you is 100% subject to payroll taxes, where an S corporation's income is not, even though you have to take a reasonable salary, which is similar to whatever you would pay somebody else in the marketplace. Now, the newcomer to the crowd, which is really not that new anymore, but over the past 20 plus years, a limited liability company, also referred to as an LLC, came into existence. And it took many years for all the states to come up with the legislation to agree with federal law on this so that they understand the benefits of this. And the main purpose for an LLC was for creditor and asset protection. Now, different than a partnership in many cases, depending on what type of partnership you set up, all the individuals of an LLC, their exposure to any lawsuits against them is limited to their share or ownership, not those of all your other member owners or shareholders. Now, the other thing that's very interesting is an LLC is a type of entity that can be taxed as either a S corporation, a C corporation, a partnership, or a single member LLC can be taxed at a sole proprietorship and only taxed on your personal tax return. So if you need creditor protection and liability protection, you can get all the benefits of one of these other entities just by starting out as an LLC. So I see more and more entities, other than those that are going public and need to be a C corporation, start out as an LLC. So those are some of the key types of structures that you have. And depending on what your unique needs are, there are times where you should become one of these and stay them, and other times when you have to transition from one entity to another.
Hey, John, I'm thinking about, one of our clients, Dr. B in Western Massachusetts.
Oh, that's right.
Yeah, when he came on, one of the first recommendations that you made for him was to look at his business structure and actually go and change it. And I think that it might be a really good illustration if you could kind of just share a little bit around his scenario and if in fact you did go and switch the structure.
Thanks, Joe. This is going to be a great example. And by the way, the fact that it's a doctor is irrelevant. This could have been any kind of business. So if you take the word Dr. Way and you put in there a architectural firm, you put in there a trucking company, you put in there a mechanical shop, you could put there a software company. It really doesn't matter. It just happened that this was a service business. So think of that if you're in a service business in a similar way. Well, this doctor who had been in practice for probably over about 10 or 15 years, he was originally, quite frankly, which is very interesting, he was a fighter pilot. So he had that competitive edge, but he had this calming approach, and he still does. And we love working with him. And I talk to him typically at least once a month, and so does Joe, because we work together on this. Well, when I first met him, and what I typically do because of my background is I ask for a bunch of information. I ask for his copies of his financial statements, the prior year, the current year, up to date, which is about 2 years ago. And I always ask for tax returns. Tax returns are a treasure of information. And with that, I found out a number of things. I found out that this doctor was doing excessively well because he worked so hard. He was making in excess of $1 million a year, which is unbelievable, but he worked extremely hard. And what I also noticed is that he only had a retirement deduction of only $24,000. I also noticed that his income was showing up on his personal return as a Schedule C. And even though he was a LLC, a limited liability company. So he did, in my opinion, get the right entity that he was in, but because he was a single member, meaning he owned 100% of the company, he could be a sole proprietorship. And on top of that, so what I immediately realized was that maybe he wasn't getting the best advice, or that he wasn't taking the best advice. And I didn't know. So I went over this circumstance and I said, why aren't you an S corporation? Did you ever get the advice to become one? And he goes, well, they kind of discussed it, my CPA, but we've been talking about this for the past 7 or 8 years. And they never said that I really needed to do this. And this was much simpler. Well, simplicity in many cases is what people are looking for, and that works. But sometimes people make a mountain out of a molehill in this case. The reality is setting up or being taxed as an S corporation was literally a form, a one-page form, and it's called the 2553. And that 2553 gives you the ability as an LLC to elect to become treated as an S corporation. Well, let me tell you the ramifications of what happened from that. Okay. Well, first of all, he was going to get taxed on the income side on whatever he made. Now, he was getting taxed on 100% of his earnings for payroll taxes. Now, if you know anything about payroll taxes, you know that every year, the way the laws are currently, they get capped on the Social Security. And currently for this year, at that time it was a little bit low, but this year it's 137,000 and let's just call $138,000. But his income, because it was being treated as a sole proprietorship, meant his $1.1 million, I think, that he was making was being taxed at the additional 2.9% for that extra $1 million plus, which cost him an extra $29,000 because somebody did not go over this with him and show him the numbers. So that was the first problem. The second thing is I look back for the last 3 years' tax returns, and he made this kind of money for the past 3 years plus. But 3 years was enough to go back for me to realize that he should have probably had a more advanced retirement plan. And if he did earlier, he would have probably saved in taxes in excess of $125,000 a year. So what I did is I recommended a profit sharing plan, which I discussed in our last session. So you may want to go back and listen to that session because I did go over this, but I can always be glad to help you out with this. And he also set up a cash balance plan, which is an opportunity for many small business owners when they're in their 50s and 60s to really basically tremendously catch up on putting money into retirement plans for their retirement. And we were able to put away in excess of $300,000, give some of his employees some of that savings. It was 100% taxable, and he wound up saving in taxes that year between the payroll taxes saved, which was last year, and his income taxes over $150,000. That's just by having somebody who's experienced in that area. And let me tell you, I couldn't tell you how many times this guy wanted to give me a hug, but over the past 8 months, I haven't been able to get anything because of COVID. So it's a little frustrating, but we work really well together, and just by having a little bit of intuition there. Now, the other thing was being in the state of Massachusetts, no different than New York, the taxes are higher than, let's say, Florida, where there's no income tax. So then you have to add on top of that another 5% for the income tax. And if you happen to be in a city like New York, add another couple of percent. This stuff gets really out of hand if we make Uncle Sam a partner in all these deals simply because somebody didn't give him the proper advice.
So John, just based off of the structure, that was a really good example in terms of, the structure, how it can have a lot of impact that way. Is there one structure versus another structure in terms of being able to set your business up for sale? One better than another, in terms of ease of selling something?
Well, typically sole proprietorships and partnerships wind up being, in almost all cases, asset sales. And they may have goodwill from the way you've conducted the business and such. So they're typically asset sales, which means that and assets are not just hard assets or intangible assets. Hard assets are, your desks, your chairs, your computers, your furniture, your trucks, anything that you own that's tangible. Plus, it's also selling your intangibles, such as goodwill and a customer base or a client base. But typically, when you're in an S corporation, it's very easy to transfer those things over. But what the problem is that buyers are looking for one type of sale and sellers are looking for another.
Yeah, and we often have discussions with clients around this. There's certain types of sales that are often like, boy, if I'm a buyer, I would love to basically go and have an asset sale, whereas a preferred by seller is more of an equity sale. And with an asset sale, just as John mentioned, what happens is you're looking at the tangible assets of the entity, and you're looking at the intangible assets such as goodwill. And in many practices, that's the big value. The big value is putting a number, a valuation on that goodwill piece. But what doesn't come across, are the liabilities of of the entity. And John, if you could just kind of like just go and just talk through for a second for us, or provide us an example or two around the tax aspects of things, whether you're going to go and do an asset sale or you're going to do an equity sale, from either party that way. And I'd also love for you to just kind of share, you sold your business years ago, becoming a part of Modera. Where did you guys end up? Was that an asset sale or was it an equity sale?
Okay, well, Joe just set me up on a softball, and he's being very candid. But we've worked together so long; he knows most of these answers himself. So, thank you for giving me a chance to share my thoughts. I appreciate it. On a buyer's side, a buyer typically wants to buy assets, and the reason why is it's a tax-driven answer. Okay, and the same is going for sellers. Why they want to sell their corporate shares in many cases, which are typically the shares of their company or the membership units of an LLC, depending on how they're set up. So let's talk about the buyer side, and I'll give you my example of what happened to me when I sold my CPA firm many years ago, even though I'm continuing to give all this tax advice in conjunction with the CPAs that we work with for small business owners like yourself. So on an asset sale, the buyer wants to be an asset sale. Why? Because it comes with tax deductions, and it's all different time frames in which you're able to deduct things. So let me give you an example. Like when somebody buys certain assets, they have asset lives. Let's say certain things like software and computers and things of that nature can be written off over 3 years. So whatever they purchase, you're able to take those deductions and reduce their taxes. If you buy furnitures and fixtures, it's over 7 years. And if you have to stretch it out for things like goodwill or other intangibles, they typically start somewhere around 15 years. But it's better than buying shares. And here's why. When somebody just buys the shares in your company, okay, the buyer, there's nothing to write off. The only time they're going to get the benefit is when they go to sell that company eventually. So if they go to sell that company eventually, then whatever you invested in that company is called your basis, or the amount that you invested in it. So if you buy something for $500,000, you run it for 10 years, and now it's worth $2 million. At that point, when you go to sell it, you're not going to have a gain of $2 million. You're going to have a gain of 1.5, which is the $2 million sales price less the $500,000. But during that whole 10 or 15 year period that you own that business, you got no deductions until you sold it for all the assets were included in the purchase, other than the ongoing rates of 3 years or 5 years. That would be a simple continuation. And in many cases, when people are buying furniture and fixtures, the people that are selling it have already fully depreciated those things. But if they had bought it in an asset sale, they get to start all over if they assign values to them. So this is the conflict between the buyers and the sellers when they're doing this. So when I sold my CPA firm back about 16 years ago or 15 years ago, whatever it was, we went through this negotiation process, or as Joe might refer to it as the dance. So what we wound up deciding to do is we wound up having an asset sale, but they kept me on for continuity with the client base, knowledge about the business, and they stayed on and got a consulting agreement. And the reason that we did that is I also got some of the benefits that went along with it. So that was the negotiating part. They were able to get the deductions of the asset sale, and it wasn't as favorable to me there, but I got a higher consulting agreement to do that. So sometimes this is going to be, a little bit of a tug of war back and forth. But at the end of the day, if you want to sell your business, the chances is that the buyer doesn't want to buy the ownership of the corporation, because Joe alluded to it a little bit earlier, because they're also going to take on the liabilities. So let's say that there was some kind of lawsuit pending, or one that surfaced after I sold the business. The new owners of corporate entity and the ownership in it would have that liability exposure. And most people don't want to take on that liability exposure. So depending on the facts and circumstances, there may be some negotiation here which way to go.
Yeah, and with any of these areas, whether it's an asset sale or it's an equity sale, I'll often have clients say, "So what's Joe? How do we go and land on the value of our business?" And there are many approaches in order to go and come up with a valuation. In many industries, there are goodwill registries where they have a percentage of revenue that have been in like sales that have been done. And that's one way to come up with a valuation. Another way is something what we call excess cash flow. Okay, after the revenue and looking at the excess cash flow versus expenses, EBITDA, earnings before interest, taxes, depreciation, amortization. You have a certain amount of excess flow there, and you put a multiple on that, and that's another way of going and coming up with that valuation. And sometimes it's a hybrid between both of those things. But one of my mentors, what he said, at our class, when I was going to do my MBA, he said, so, what is the value of any entity? Okay. And we were kind of like, showing him all these different types of approaches on coming up with the valuation. And he said, it's what someone is willing to pay. It is what someone is willing to pay. And oftentimes what happens is, we can do all these valuations in terms of intangible assets and tangible assets, but if somebody really wants something, or it's a competitive situation, what's going to happen is you can throw everything out the window. I have one client of ours that he owns a hotel, and based off of this hotel, he really wanted this restaurant. He really wanted this restaurant name, as hotel, and the name of that restaurant was Sonoma, and that's the only thing he wanted to buy. He didn't want to buy their recipes. He didn't want to buy anything else. He wanted to buy the name Sonoma. So that buying that business was just to basically get that so that he could use that going forward on things. John, do you have anything else you wanted to just share around this in terms of this piece? But I think that it all kind of goes back to the budget and looking at the numbers that way. John, you're a numbers guy. If you could just kind of talk around this whole aspect of an active rolling budget.
Yes. Well, just to follow up on a previous slide, just for 1 second, I think what it comes down to is what are people looking to buy? And if they're looking in a specific industry, whether they want to buy a mechanic shop, whether they want to buy a dentist practice that's already up and going, whether they want to buy a software company that's in place, they're going to look around, and there are so many factors that go into what they're willing to pay, as Joe just expressed. It could be geographic location. It could be the name of the business that rings. It could have a long-term goodwill or branding. Can you imagine like Coca-Cola buying Pepsi? They're probably not going to make Pepsi go away. They're going to keep that name, but it's going to come at a price. And it may be above the book values or the cash flow because they see it as an expansion of dominating in a marketplace. I mean, you could have how many people have you driven up to a light and it's a busy intersection and all four corners there's gas stations and you were looking for a gas station to buy? If you sit down with each of those, one may say, I'm not willing to sell. And the other three may say, yes, I am. So you look at their books and records, which would be a great lead into this, and you're going to see what their earnings are. You're going to see what their staff is, whether they've been there a long time. You're going to see what their trends lines are. You're going to see how long they've been in business. You're going to see whether it's an easy business to take over. And you actually may pay in excess of what they're even asking for because you have found a value. Or the opposite, you may underpay what they're asking for because nobody else has showed up with a check yet, but know that you can just make a couple of tweaks and make that thing even so much more profitable by the way you lay out the design, where you have a piece of software that can make it more efficient, whether you can bring in a staff member that'll change their marketing plan simply because you've done this before, or you maybe done this in a different town. There's so many factors. But in trying to set up your business, what's really important and while you're running it, and this is not about selling it, this is to just operate it. And in the end, meaning like when you're prepared to sell it, you've already put things in place.
Yeah, John,
do you have anything else you want to add?
No, I love you to just, you at the beginning, you talked about a client that was in construction. And I think that's kind of a good story to show some elements of, sometimes the timing's right in order to sell. And I'd love you to just kind of just share that before we just talk through this rolling budget.
Oh, that's right. back in 2005, I was functioning as a CPA there, as well as just getting into this business. So I understand the planning and the financing of it. And I was talking to a couple where the father had died about like 6 years earlier, and the son came into the business with his mother, who was taking care of all the books, all the records, taking care of all the back office, taking care of HR. So he was there to be the marketing person. And he was fairly young to be doing this, and only was in the business with his dad for about 3 years, and he was probably about 26 or 27. And he came in with a lot of ideas, was butting heads with his mother about how to expand so rapidly and everything else. But I was having trouble getting him and wrangling him to a table to say, we've got to come up with a business plan. And I said, it's not going to be a stagnant business plan. It's going to be a rolling business plan, one that gets updated with new opportunities. And as the numbers became evident on what the trends were going and with things that he can control and things that he could take advantage of. Well, by the time 2006 and by the end of 2006, I started to see the bubble in real estate going on. And with the bubble in real estate relates to construction, which related to his business. It was a lumber yard. And that lumber yard at that point, based on the way it helped him and his mother move the business to be more efficient and effective, got up from a 4 times revenue to almost 11 times, not revenue, cash flow. And it went from when I first met them 10 years earlier to being worth around 2.5 million. And with their efforts, they grew the business. It wasn't me, but what I focused them on making sure that their records were up to date and how to manage the business by looking at the income statement and the balance sheet and paying attention to the things that can get out of hand really quick or out of sight because you're not looking at it. And therefore, you don't want the funnel in a business to be as large with, new growth and new business coming in to be as large as the bottom funnel when the expenses are going out and you don't have that extra cash, or as Joe described, as extra free cash flow. So what wound up happening was he got a little greedy. He wasn't listening to me. He was a young buck in the stalls. And what wound up happening is 2007 hit, 2008 hit, 2009 hit, and there's the rest of the story. Real estate went in the tank. The business dropped off tremendously. And his multiple, which was at a peak, he could have walked away with $13 million. His mother would have got half of that because they were 50-50 at that point, the way we designed it. His mother would have had this tremendous retirement package. He would have been able to have money, which he could have just put aside for his future retirement and took another $1 million or $2 million and started a whole nother business. But he didn't follow the advice. And only about 1 year ago today, he sold that business for $2 million. And guess what he sold it for? Was for the remaining assets in the real estate. When we were selling the business at the 11 times multiple, that was just for the business. The real estate alone is at that time worth $1 million. So the only buck he got out of this thing is that real estate came back and went up. So timing is very important. And like I said before, opportunities are there only once in a while. And when they show up, you have to make those kind of decisions. But you can be in the best light if you set yourself up. So let's look at some of the things that you can use in a rolling budget and be managing your business by statistics and the numbers to be indicators to work with your key employees so that you can make changes and bolster up things that are doing well and make adjustments during the year, not wait for the end of the year to find out that you could have done something. So when you're talking about an income statement, the 2 main areas there to look at are your revenues. Now, you may not have one source of revenue, so you're going to want to look at the different lines of business that you have to see those trend lines and see how they're going up or how they're going down. They're going to be impacted by many things. They're going to be impacted by the economy. They're going to be impacted by your specific industry. They're going to be impacted by your marketing. They're going to be impacted by your product and your service. So you have to be aware of what are the things that are making it go up and make sure that you don't go backwards on those things. And if you start to see dips, it's because you change what? Maybe your marketing plan, maybe your service reps are getting grouchy and they're not going back to customers when they ask when they used to be. Maybe there's a life event on one of those people. There's so many factors. So you have to stay on top of those kind of things for revenue. On expenses, things can sneak up on you on expenses. It's very odd. But expenses can happen this way. Let's say you have insurance and you decided that you wanted health insurance for your company. Now, year over year, you typically have to get your insurance renewed in many cases. And if you start to see that they're going up exponentially, it could be eating into your profits tremendously. We made a decision years ago. We had we started out at no health benefits, then we went to 100% health benefits. Then we decided that maybe the staff should buy in a little bit, because then the numbers have started becoming higher. So now I think we have like an 80-20. We were still paying 80%, but then we added other benefits that became part of a package as an incentive to stay. Then we added 401k plans, then we added profit sharing plans. But that was only when things got better and as you grew. So this isn't something you can always do at one time. But there are other expense line items in there that you have to monitor to see where they're going. It could be travel. It could be entertainment. Maybe your salespeople are taking advantage of you. Maybe you didn't realize that. Maybe it's slow. Maybe it goes down and then it comes up. But you have to see what the longer term trend line is. So you not only want to look at this either monthly, but probably quarterly and definitely annually, so that you could see this. But please look at your numbers at least monthly or quarterly, so you don't wait until the end of the year before you see those trends. But let me talk to you about two other key areas, just in assets and liabilities, are receivables. It's three areas: receivables, inventory, and payable. I got to tell you, if you let your receivables get out of hand, it's because you're not addressing those issues and you're maybe afraid of confrontation, or maybe you're just not paying attention. But if your receivables start to dry up, it's so much harder to collect a month or 2 or 3 months later when you have to go back to clients, because maybe they don't have the cash flow then. So find ways to get those receivables. And don't you have an illustration of that with a client that we talked about earlier? About
yeah. So just around the whole receivable aspect of things, we're next going to kind of go into an approach in terms of, let's say, looking at opportunities to go and improve things. In this one business, that was the thing. The thing was, receivables were high, not trending in the right direction. And what we did is we put a focus on that, back February and March, just around the COVID starting time, and we said, what we're going to go and do is we're going to go 100% to e-signature and e-payment. And all of a sudden, where before we were chasing after money, we're trying to go and pull it in, and it was just driving the staff of that business bonkers. Then what we did is we were able to go and put in, electronic payment, and with via DocuSign, and all of a sudden accounts receivable went almost to zero. And just think of just like a transformational type of thing, by going and looking at something and saying, is there a better way? Is there an approach that we can go and use that is going to have a transformational effect, just based off of that. And I think you can go and take it along any of these things, whether it's revenue, where it's like, okay, do we have a mushy pipeline of prospects or other types of things here. I think we could basically go and dig into any of these things. But just as John said, at a minimum, this has to be, you have to be looking at this thing, quarterly. But if you're able to look at this on a on a monthly basis, and especially if you're going to be going and saying, okay, 18 months from now, we're going to basically be setting ourselves up for a sale type of opportunity. What's going to happen is that's going to really increase that excess cash flow that multiple is going to be applied to. So it's really quite important.
Yeah, when you just one more thing, Joe, on that last slide, if you don't mind.
Yeah, sure.
Yeah, just one more thing. Well, two quick things. At the end of the day, when you ultimately try to sell your business, and we'll talk to you about that now, we're going to go into a great exercise that Joe and I have done together, is that people are looking for a return on their investment. No different if you went and tried to buy a stock or a mutual fund or whatever. You want to try to get a decent return on your money. And in order to get a decent return, you don't want to be going to buy a business to basically just buy a job and not have any excess cash. Because if you bought a business and that person that you would put in a leadership role to run that business, if you can find somebody to do that you trusted, even collaborated with, but you didn't have to be on site, just make believe for 1 second, then maybe you have to pay that person $100,000. It depends on what the position is. So you don't want to just get that person a job and not get a return on your investment. So your cash flow is ultimately your return on your investment. So the more that you can have that excess there, you can do so many things with it. You could expand your business. You can hire people at better levels. You can provide benefits. You can provide better machinery, better software, which will just be an attractive prospect, not only to new hires, but to people. When clients and customers come into your location or meet you online these days, they want to see somebody that knows what they're doing, that's organized, that comes across as polished and professional. Even if you're a mechanic, it doesn't matter. When I get into my car after my mechanic and I see that they put on a plastic piece on my car seat, and then I see on the floor they have the floor mat, I feel like they respected my asset. If I go into a mechanic that doesn't do it and there's grease on the seat, I may not be going back. So all these things factor in. And the last piece on the last one I want to go over is, please, if you have a business that has inventory, don't wait till once a year, every 2 years or so to do a physical inventory. Your inventory can be walking out the back door if you have a lot of parts and things like that, or even if you're a restaurant. Food walks out the back door, and it actually walks off the front door if you're not monitoring it. People getting free meals for their friends if you've got an employee who's done that. Or if you have a bartender in a bar and they're pouring excess drink for their buddies when they come in when you leave. So that goes hand in hand with having great employees. But if you know what the spillage rate should be for a bar and you know it, you can factor all those things in. So that's by seeing those trend lines, you'll be able to find those things that don't look right and fix them.
Another thing that was always been taught to me is inspect what you expect. So if you're looking at those numbers, you're gonna find that they're actually, by going and putting some focus on them, things are going to go and change that way. And there was one instance where I was brought in as a consultant to the small business, and the administrator was very, very elusive in terms of providing me any of the financial data. And red flags kind of went up. We started digging into things forensically, and comes to find out she had put her daughter's wedding through the business. She put her son on the payroll, a whole bunch of other things that way, because that's wasn't being inspected that way. So I think that you got the plus and the minuses of this whole thing, but looking at the numbers that John talked about in terms of that rolling budget stuff is just so vital. Now, what I want to do is I want to share with you something to kind of unlock the value of your business, and it's an exercise called Sailboat. And I've done work with a lot of businesses. John and I work with a lot of businesses, where we're going and helping them, let's say, kind of really figure out exactly what their lighthouse is. Okay, where are you trying to go? Working on the plan stuff. And what I've learned over the course of time, when I provide a whole bunch of questionnaires to business owners, if there's 10 of them there, 2 fill them out, another few fill them out just a little bit, and then the rest don't do them. So with Sailboat, this is a really great exercise where it doesn't require any preparation. You get the key members of your team. You can even have some key members of some different departments that way. All you need is Sharpie, and you need some Post-its.
And a wall.
And a wall. Yeah, you need possibly sometimes it might be two walls that way. And the way that it works is I'm just going to kind of head into this next piece. It starts off with you have your it could be your 3M sticky yellow flip chart sheets, and you have a water line, and then that water line, you have things that are below the water line and you have things that are above the water line. But what we're trying to do is we're trying to really go and say, okay, where are we trying to go with this business? Are we going to try to take our business from 8 million to 16 million? Are we going to try to go and sell it, or improve the profitability? What are we going to go and try to go and do? And then what we do is we take 2 minutes. Everybody gets their Post-it, and then what we say is over the course of the next 2 minutes, I want on each Post-it, I want you to write down something now in that bottom right quadrant. What is internally? What are anchors that are holding us back right now from getting to our lighthouse of where we want to go? And then what you'll see is everybody, over the course of those 2 minutes, will feverishly write down things. We'll organize them, put them up, and then we move on to sales. What are the strengths of the business that we can go and leverage that are going to go and get us to the lighthouse? Okay, get all that information, put that together, come up with the top two, and then storms. Above the waterline, what are the threats that are out of our control? Boy, we saw one that hit us right between the eyes in March with COVID just being one of them. And then trade winds. What are some things that we can be going and doing that, blue sky? What are things we can be going and doing that are going to go and accelerate us in order to move to this lighthouse? And John, you and I, with Modero, I kind of took you through this exercise, and I'd love for you to just kind of your insights in terms of things, and then I'll show you how it basically goes and comes together.
I felt a lot of pressure, Joe. You only gave me 2 minutes and I had a million ideas. But the thing that's funny about it, though, is the things that come to mind first are probably the most pressing things. But you may start out as a sole proprietor and you do this. So you may be looking at yourself in the mirror. So you got to be your own best critic and also your best advocate, right? I mean, you have to have some faith in yourself and a lot of confidence in yourself to go into business. But you also have to be fair to yourself and say, I have to be aware of the things that are shortfalls. But as your business grows, as Joe says it, having some other people in the room with you, key people that'll help you and be, quite frankly, honest, is what's really helpful. Joe and I actually did this exercise together for our own company. And we have now, I think, roughly 70 employees, and they're in 5 different states. So there's a lot of factors that go into, every single business is going to be unique. And what we went through this is it became very apparent that we knew the things that we had to make sure that we support and bolstered up, which were the trade wins and the sales that we had in our favor. But then we had to be very honest with ourselves and say, what are the anchors that we think are holding us back? Now, some things, what comes out of this is you get all these sticky boards like he's showing you up on there. And what I actually asked Joe, I said, Joe, I need another 3 or 4 minutes. So what you then do is you kind of prioritize these things, say, where can we have the biggest impact in the shortest period of time? And what are the things that we know are going to take longer, but we have to get other people to get buy-in from so that they can hold us to the task and make sure this gets done. And I will tell you, I learned something a very long period of time ago. If you have more than 3 priorities, you don't have any priorities because you're trying to do too many things at one time. So if you can find a way, which is what I expressed in our very first session about 2 months ago, is you have to find leverage. You have to have the people that have the passion in the area, have a knowledge in the area, and know how to keep this thing moving forward. That's what I think was the biggest helpful hint here. It wasn't the fact that you can find the good things that are going on, the things that will prop you up, the things that are holding you back and everything else. That's important to be honest. But then being able to assign it, and more importantly, hold people accountable, especially yourself as the owner, to hold this all together.
So yeah, the most important thing with the sailboat exercise is there's no preparation. I've done it over a dinner. When we could do dinners, and then you pass them out, and you okay, let's go through. Over the course of the next 2 minutes, what are the anchors that are holding us back? And what happens is that one business around the accounts receivable. We had some of the key members of that group, and they just basically said is accounts receivable came up, and they talked about how frequently they have to get out of their chair every single day to go to that credit card terminal. And so what this exercise does, it comes up with the what, and then what you have to do is once you decide exactly what those maybe 2 or 3 things are that you're going to work on, then what you're going to need to go and do is figure out the how. Like, how are we going to basically go and do that? And then I'm just going to just show you, just real quickly, this piece. But this is a really, really powerful tool. This is a real powerful tool, just based off of this piece. And, this is something that I would suggest that a business, can do at least 2 times a year, or even or even quarterly. And boy, does it keep you really, really focused in terms of moving to your, moving toward your lighthouse and adding value to your business going forward.
Yeah, the rewards are tremendous because at the end of the day, as you make these improvements, not only is your the business becoming more valuable because you're going from being, like a practice if you're in a service or a profession, to becoming a business entity or an enterprise. And the more you can put systems and procedures to create more consistency on your deliverables, which are your service or your product quality, then your business becomes more valuable. So all these things lead to positive results for people, for environment. It's much more upbeat, but you do have to make sure that you're accountable and watching the numbers and coming back every quarter or every 6 months at the most. I would recommend. You don't want this thing to slip away because another new project showed up and got in the way. To make time for this, and I brought that up in one of our previous sessions, is to make sure that you're looking, you're monitoring and maintaining your business by putting some time aside, whether it's weekly or monthly or a combination of both, to do different things to make sure that you stay on task to get these things done. Not just yourself, but all those other people that may be helping you in your organization.
So as we talked about, John started off, talking about the aspect of, what is the entity of your business? What is the structure of your business? You really should go and look at that. Is there a way that a better structure is going to add more value? Add more value for your business. And then the second thing that we discussed was the aspect of the active rolling budget and those key performance indicators and the things that are on the income statement and the balance sheet. How can we really focus on those? And then that third thing is it's the plan. And what's really interesting is when clients come into us, say 99.9% of the time they don't have written financial goals, but when they finish with us, they do. And that by going and utilizing something such as Sailboat, that is going to get some things on paper, so you're able to go and work to them. And this picture is a picture that I took just outside of Barcelona at Montserrat, which is a beautiful monastery up in the hill, and they have this rock, concrete blocks, and you have to jump over a fence. You got to go and climb up, and this girl climbed all the way to the top, and it's about 1,000-foot fall. And it just kind of made me think of, small business, selling your business, whatever. You have exhilaration, but it's also scary. And you got to make sure that you're going and surrounding yourself with advisors that are going to be able to provide you, good advice, and also take some of your own biases, out of the picture that way. John, we're coming up in these last couple minutes, based off of our presentation that way. Is there anything else you'd like to kind of share with the group in terms of closing?
Well, when you're running your business, and even if you have partners, sometimes, especially if you're by yourself, it can seem really lonely at the top. Having people around you internally and externally is critical, that can challenge you on some of the things that you're thinking about doing or want to do, because the collaborative nature of people, if you're treating them well, will want to see you succeed. And if they're your partners, they're going to want to see you succeed even more because it hits their pocketbooks with you as well. We're in this life one time. You should try to do the best job that you can, and utilizing other people's time, energy, and talents internally and externally will help you get there a lot faster. It's an investment, no matter who you're going to get to help you. So run those questions by people. As a matter of fact, me being a alumnus of St. John's, still following us, even though we're calling ourselves Red Storm, I'm still Redmond, so to speak. And I still believe red, I guess. I think that's actually what I do believe. And we are making ourselves available as we have, and I have helped a number of people who have attended these sessions by giving me a phone call, and we can tell them, you can ask questions. You don't have to become a client. If you become one, that's fine. If you don't, at least we know that we're steering people in our community of St. John's in the right direction here, and we can give you that general advice on what it is. the legal structure and the other things that we talked about tonight. I can help you, and Joe can help with trying to help you get to the right people that can have them make these decisions locally for yourselves. So please just reach out. Now, we are going to be posting some other resource materials for you, which we've done since the beginning of the first session, on our website at moderawealth.com/free-resources-St. John's. If you want to just take a picture of this, it may be easiest with your phone, quite frankly. I always forget to do that. Or these slides will be available to you, or just go on to moderawealth.com and just follow it. Stacy will also be sending a follow-up email that'll help you with some of this information. And we look forward to talking to you about this. I do want to go over and summarize where we've been and where we're going, though, with the next session. So in the meantime, if you do have questions from this session or any questions regarding any of the things we've talked about, please just start posting them, and we'll go over and answer your questions before we get off tonight. We'll be here for another 10 minutes or so as you need us. But this is a summary of what we've covered so far. And we said that we'd give at least 10 strategies. I think we wound up giving a lot more. But basically, the first session, we talked about leadership and leverage and how that will help catapult your business by having the right people around you and knowing how to get the most out of your staff and be an inspiration to people. You shouldn't just be managing them. You should be helping them make the best decision and doing that by managing expectations. And when you're doing that, you also want to know how to attract and build an elite team. You also don't want to take on the wrong clients or customer base. So that goes with expectations of what your service is going to be like, or the type of product you have, and what the warranties are. You have to stand out from the crowd. There's got to be something that makes you unique. It can't just be price all the time. Then there's the next session we went over, which was the last session. We went over how to keep Uncle Sam at bay, which really relates to minimizing your taxes and understanding how to do that. And then we went over a little with that example today about the doctor. And then the other one was about picking the best retirement plan, which I alluded to a little bit today in one of my examples. And today, of course, we went over how to bolster your business. So while you're in it and you're running it, you're getting the most out of it, and you're growing something that you can take pride in, and it ultimately will repay you in the transition one day when you go to sell. So those are the kind of things. And also, of course, making sure that you have the right entity, which is very foundational, so that you don't have to pay more taxes than you need to, and also have the right protection in place. The next session that we're going to be going over is going to be relating to how you attract the right clients through, what are the best marketing trends for the different types of business, and how you can use technology to establish an online presence. And it's time to put down your rock and chisel and just stop trying to just beat the pavement here to get new clients and things like that. But how you can use social media to establish a brand. And if that's ever been more important, it has been for the last 8 months while we've been in this pandemic. Well, many people, other than essential people in the community that had to go to work to help us, whether it was a medical profession or others, this was a chance for you to be able to stand out online. And how do you attract people, whether it's with a search engine that you have or others. So we're going to bring in 2 other specialists next time, and that's 1 month from now, which is on the first Thursday of December. So please stay tuned for that one as well. Joe, do we have any questions that have been posted?
Yeah. Just I wanted to just pass one question on, and then I'll basically pass it back over to Stacy. But question was, what are your thoughts on taking on nonprofit initiatives with your business? And you see that there's a way to kind of have the nonprofit profit aspects of what you go and do within your small business.
Are you talking about providing your product or service was the question to a non-for-profit? I want to make sure I understand the question.
Yeah, the question is, what are your thoughts on taking on nonprofit initiatives with your business, and can the two be merged?
Does that mean being in a business that could have a nonprofit component to it? It's either that or you're supporting a nonprofit. I'm not sure exactly what they want. If they want to type some more clarity, that'd be helpful. But if you're working with a non-for-profit, or I think where the question is going is if you want to act as a non-for-profit, you can still make money in a non-for-profit. It depends on, what you're trying to do. Typically, most non-for-profits try to have as low as administrative costs to running that business. So the money that comes in that may be charitably inclined is getting to the people or providing the services to those people, whether it's to the veterans, whether it's to a church, whether it's for animal shelters or whatever it is. You still may need to hire people to run that business, and you can do that. So many of the same focuses on running a business should be done the same way. You still have to be efficient in running any type of organization. It's pretty funny. I'm Catholic, not that I had to be to go to St. John's, but I am. And I used to always have these discussions with the priests when they asked me to come by. John, what's your background? Can you help us out, at the church and coming up with a budget and this and that? And, I used to every once in a while get into the discussions, depending on who the priest was. He's like, God will provide for us, John. I said, well, I have a little bit of a caveat to that. I used to always say, God will provide for those who help themselves. So with my knowledge, I'm going to help ourselves here. And we need to make sure that the revenue coming in the pews, on Sundays and stuff is going to be enough to cover all our expenses and have some reserves. That's the same philosophy you have to run in a business. You can give more of the excess cash instead of going to personal profits and reasons, but then give it back in terms of expanding the services of the not-for-profit. So yes, I think the same philosophies and the same motives on making sure that it's done in a business-like manner will be very helpful for any not-for-profit.
Well, John, thanks a lot for the answer, on that question. And, on behalf of both John and I, we really appreciate this opportunity to kind of share a few pearls, based off of John and my working together, helping small businesses. Stacy, back to you.
Well, thank you, everyone. And thank you for joining us today. A very special thank you to John and Joe for sharing their knowledge. For their full bios, please go to stjohns.edu/CF webinar. Here you will also find a schedule of upcoming webinars and past recordings. I hope you will join us Thursday, December 3rd at 6 p.m. as we continue our small business series and discuss incorporating marketing trends to fast track your business. In the meantime, have a great evening.
Hey, just one thing, Stacy, just one last note. Please, for the sake of Stacy and for us, as we develop these kind of sessions, please, even if you don't have questions, can you please provide us feedback on the material that we supplied, whether it was as helpful as we hoped that it was? And if there were some things that maybe in this type of session that you would help to learn, and maybe we can add other sessions to expand on this subject matter. Thank you so much for your time in sitting with us this evening. Joe and I appreciate the chance to reach out to our communities so that we can be a resource. Thank you so much and have a good night.
Good night.